So, where does the tax-free withdrawal of funds come from? How does that happen? Hello, everyone. I'm Scott Schwartz with nevertoomuchmoney.com. I've reverse engineered the way that banks and the wealthy use their money so I can help my clients become their own virtual banker. So, in talking about how cash value life insurance can be used as this fund from which to get compound interest, and yet when I withdraw from it to be able to invest or to eliminate debt, that pot never sinks. It stays level and it continues growing uninterrupted compound interest. Sometimes when I explain that concept to people, this sounds too good to be true alarm goes off and they just shut down. And they don't hear anything else because they immediately make the determination that can't be right, that doesn't make sense, forget you, I'm not going to listen to anymore. So how is it that that is really sound financial science? How is it that that works and that it makes sense to where even a layman can understand it and trust it? Well, here's what happens. The key is in where is that money coming from? So we have the money with an insurance company, and this pot of money is actually our cash value in our policy. When we say we want to withdraw funds from it, we are withdrawing it as a loan, not as a distribution. A distribution would be what we would make from, say, a mutual fund, from stocks, and it would immediately be taxable income. What happens in this case, again, where is that money being borrowed from? It's being borrowed from the insurance company in the form of a loan. It's not coming out of our pot of cash value. So let's say you have that policy with Mass Mutual, just to throw out a possibility. This cash value is unaffected because it's untouched. We are not borrowing from it. We're borrowing, in this example, from Mass Mutual. They are giving us a loan, not from our cash value. Our cash value is collateralizing that loan. That's how we know, that's how they know we're good for it, and why they are not concerned even if we never pay it back, because they know they'll get it back in the end regardless. So we borrow from the insurance company's general fund, so our pot never diminishes. That's why it stays intact, and that's why our compound interest grows as if we didn't take any money out, because we didn't take the money out from here, from our own cash value. We took it out from the company, from Mass Mutual. They gave us a loan from their general fund. Okay. So there's no smoke and mirrors. There's no slick salesmanship. There's no bait and switch. It's very sound financial science. Where is the loan coming from? It's not coming from our policy. That's why the policy doesn't sink. Okay, so I hope this helps and hope this enables you to visualize the science behind this and why we can trust and have been able to trust for over 100 years what these mutual companies do on a day-to-day basis in order to fulfill their obligations to their policyholder owners. So I'm Scott Schwartz, Never Too Much Money, and hope you enjoyed this information. Thank you.